In a world still reeling from the shocks of a global pandemic and geopolitical tensions, the regional banking sector stands at a crossroads. As 2024 unfolds, these banks, often seen as the lifeblood of local economies, grapple with an unprecedented mix of challenges and opportunities. From the acceleration of digital banking to the pressing demands of climate-related financial policies, the landscape is changing rapidly. This essay explores the multifaceted aspects affecting regional banks and forecasts the pivotal trends that stakeholders need to watch. The global economy's heartbeat is quickening after the pandemic's chilling effects, with regional banks feeling the pulse. In areas like the United States, these banks face a dichotomy of burgeoning loan demands, spurred by revitalized consumer spending, alongside the menacing shadows of inflation and rising interest rates. The economic revival varies significantly across regions, influencing banks differently based on local economic conditions. Regions showcasing vigorous job creation and real estate activities are witnessing their regional banks prosper. In contrast, areas lagging in economic dynamism might see increased loan defaults and heightened credit risks. This part of the banking sector, deeply embedded in local economies, must navigate these turbulent waters with keen insight and adaptable strategies. Thus, understanding the nuanced impacts of economic recovery on regional banks is essential. It's not just about recognizing the opportunities, but also mitigating the risks associated with uneven recovery landscapes. 2024 sees regional banks caught in the winds of change, driven by a regulatory environment that's tightening under the Biden administration. Focus areas include consumer protection, financial stability, and stringent anti-money laundering protocols. Compliance is no longer just a checkbox, but a significant operational lever that influences everything from cost structures to strategic positioning. The introduction and implementation of Basel III standards are particularly transformative. These regulations compel banks to maintain robust capital reserves and favorable liquidity ratios, directly impacting their lending capacities and profitability. For regional banks, the challenge is dual: align strategically to these regulations while managing the increased cost of compliance. Therefore, navigating this new regulatory landscape is crucial for regional banks. It's about balancing the scales between compliance costs and leveraging regulatory changes as a means to fortify trust and resilience in the market. As digital waves reshape the shores of the banking industry, regional banks are urgently retrofitting their operations. The transition from brick-and-mortar branches to digital platforms isn't just a trend but a survival strategy in the tech-driven world of 2024. Investments in cutting-edge technologies like cybersecurity measures, data analytics, and artificial intelligence are no longer optional but imperative. These technological investments serve a dual purpose: enhancing customer experience and operational efficiency. For instance, AI can streamline loan approval processes and personalize banking services, attracting a broader demographic, including tech-savvy millennials and Gen Zers. Exploring these technological frontiers is vital for regional banks aiming to stay competitive. It's not just about adopting new technologies, but integrating them seamlessly to redefine banking experiences and expand market reach. 2024 also witnesses a significant reshaping of the regional banking landscape through mergers and acquisitions. Smaller banks, squeezed by the dual pressures of regulatory compliance and the need for technological upgrades, find solace in merging with larger entities. This consolidation promises economies of scale, enhanced competitive edges, and potentially better financial health. However, the flip side is the threat to market diversity. As banks merge, the industry could see reduced competition, which might limit options for consumers and potentially drive up costs. Analyzing these M&A trends offers insights into the future structure of the banking market and its implications for stakeholders. Understanding the dynamics of M&A within the regional banking sector is crucial for predicting its long-term impact on competition and service offerings in the market. The specter of climate change looms large over all sectors, with banking being no exception. Regional banks in 2024 are increasingly aligning their operations with sustainability goals. This shift is not merely about corporate responsibility, but a strategic positioning that caters to a growing demographic of environmentally conscious consumers and investors. Financing projects that support renewable energy sources, eco-friendly practices, and integrating climate risk assessments into lending decisions are becoming standard practices. Banks that proactively incorporate these practices are not only bolstering their reputations, but are also setting themselves up for future financial success. This section delves into how regional banks are navigating the challenges and opportunities presented by the need for sustainable banking practices, and what it means for their future operations. As we encapsulate the diverse influences shaping the regional banking sector in 2024, it's clear that the path forward is fraught with both challenges and opportunities. Economic recovery, regulatory environments, technological advancements, M&A activities, and climate change initiatives are all playing significant roles in sculpting the future of regional banks. For investors, policymakers, and consumers, staying informed and proactive is more crucial than ever. Understanding these trends and their implications will be key to supporting and benefiting from the robust growth and transformation of regional banks. In conclusion, the regional banking forecast for 2024 provides a complex yet promising outlook. Strategic adaptation and informed decision-making will be paramount in navigating this evolving landscape.